The Property Pod. Welcome to The Property Pod with Moneyweb. The property sector is an ever-changing sector, and in this podcast series, your host Suren Naidu chats to movers and shakers in the property industry.
Hello, after the Easter long weekend, welcome to The Property Pod, South Africa's premier property investor podcast. My name is Suren Naidu, and on this Moneyweb podcast show, we gain insider insights from leading executives, analysts, developers, and entrepreneurs in South Africa's expansive property industry. The logistics subsector of the property industry is arguably the top performing part of real estate, both locally and globally currently. Another sector that is doing better than the offices and even hotels in South Africa is the convenience retail property space. JSE-listed Fortress Real Estate Investments plays in both these top-performing subsectors of the commercial property market. However, it has had some issues to deal with over the past year or two, which saw it lose its Reit status last year. But this year, things turned around on that front too. Listed property players and market watchers will know what I'm talking about. On that note, on the Property Pod today, we are joined by Stephen Brown, the CEO of Fortress, to talk to us about the logistics property market and what's happening in the group. Welcome to the Property Pod, Stephen.
Thanks very much, Suren. Good to join you.
Stephen, the company's single share structure was finally sorted and has had a positive impact on the group, with the group resuming its dividend payments from its latest results. How significant is this for the group, as it has been a tough slog to get over the line with this issue?
Yeah, it really has. I think it's been a distraction both for us and for the board, and caused a lot of confusion in the market as to which share was worth how much, and I think led to a bigger discount than really was necessary on the listed equity. So it's fantastic that we've now got down to a single share in a very understandable vanilla structure. And I think that means it's far more investable for the average investor. It's more liquid, more understandable. So the dual share structure of the past is behind us, and now we've got a single share, which is really what we've been trying to get to for, I would say, probably the best part of 4 years.
And what does this actually mean from an investment perspective for these shareholders?
Well, what we did to solve the dual share structure is we repurchased all of our one class of shares. So almost half of our shares we repurchased for about a 50% discount to NAV. So the shareholders that remain now have got this really, really big uplift in net asset value. That's one benefit. The other benefit is now we can pay dividends again, because the dual share structure prohibited us from paying dividends in certain scenarios. So now we can pay dividends really just subject to the regular Companies Act requirements and at the discretion of the board. So I think that's a huge win, because a lot of listed property investors like a regular dividend. So that's a big plus in our eyes for creating shareholder value. So I think that's really the primary positive, is that we can pay dividends, and it's a very understandable structure now. Just one share to look at in a world that's complex enough. I think we didn't need to have the dual shares and the complexities between the different classes. So now it's very vanilla and understandable.
So talking about dividends and resuming your dividends, does this mean Fortress will regain its Reit status? If so, by when?
So I think the question is, and this is something that we must ask ourselves, is, well, why would you want to be a Reit? Well, a Reit gives you two things. It allows you to, the income tax that you might pay, if you pay a dividend, it then allows you to deduct that dividend. So if you are paying a lot of income tax within a company that could be a Reit and you become a Reit, the company doesn't bear that tax burden. It pays a dividend, and the dividend is then taxable fully in the hands of shareholders. And the other benefit of being a Reit is you don't pay capital gains tax, but nor do you recognize capital losses on the sale of property. So then we need to say, okay, how big is the income tax in our life? And are we better off declaring that and making that taxable in the hands of shareholders? Well, for this year, we're estimating roughly 70 to 100 million of income tax. So that's about 5 or 6% of our distributable earnings. Very, very low tax rate. Plus, then we go to the second one, capital gains tax. Well, we actually have a deferred tax asset on our balance sheet because of historic capital losses, which if we were a REIT, we would need to reverse. So, and that's about R1 billion. So we would, if we became a REIT, we would then burden our shareholders with all of the exempt income that we get from, for example, our NEPI investment, plus we would lose some deductible allowances from our new buildings. So we would then pass on a high tax burden to our shareholders, and we would lose R1 billion of our deferred tax assets. So I think because those two are not material, well, the income tax is not material and the capital gains is actually, would swing the other way. We would lose an asset off our balance sheet. We then wouldn't see any incentive for us to become a REIT. And really the difference with our makeup of our income is that we get exempt income from NEPI in the form of an exempt dividend, and we have a lot of new building allowances which we can deduct, and that acts as a very, very nice tax shield. If we were a REIT, we wouldn't have that. So until those two items change, in other words, we're paying a lot of income tax and perhaps we're paying a lot of capital gains tax, we would never be better off as a REIT.
So the short answer to that, it's unlikely that you'll be a REIT anytime soon.
Well, yes, because I think that the tax shield and the income tax stays low for a while. And we fortunately or unfortunately are not selling our assets, our non-core assets, at a big profit to the base cost. So we don't forecast any significant capital gains tax. So yes, better off as a non-REIT, and until that changes, which will be probably only the medium to longer term, we're likely to remain a non-REIT.
On that note, just thinking about dividends, whether you're a REIT or not, you're still a listed property company, and you're one of the few companies that's paying 100% dividends. How sustainable is that for the company, considering a number of your peers are reducing to 90% or 75%? Some are not even paying interim dividends. I'm sure your shareholders are happy at getting those dividends, but it's worth asking.
Yeah, so we're happy at 100%. So a few years ago, we looked at, rather than some sort of payout ratio, we just looked at, well, how do we define our distributable earnings? And really, we've taken quite a conservative view, and our distributable earnings are largely cash backed. So we have gearing that's sub 40% loan to value, even after buying roughly 7 billion rand of our shares back. So our gearing is low, and we've defined our distributable earnings on a principal basis so that it's really cash in, cash out, and we're comfortable to remain at 100% of our distributable earnings as a payout. Whether the market does that or uses SA REIT as a guideline and then applies a payout ratio, I'm not entirely sure what each of our individual peers do, but I think we've taken a principal stance on our distribution, and we're comfortable with where our balance sheet is to pay that all out on a semi-annual basis to our shareholders.
Talking about LTV, I didn't mean to get so technical in this interview, but you mentioned the LTV is around 40%, but you're almost a development fund in many ways, considering your extensive development pipeline, which is a separate question that I'm coming to. Are you comfortable with that LTV at what did you say, around 40% currently?
Yeah, it's about 39. Yes, we are comfortable there. You know, we do have a reasonably large development pipeline, but we've been selling assets to fund that. So, you know, we've managed to actually sell over the last roughly 4 or 5 years. I think since 2019, we sold at the end of this financial year, we would have sold roughly 7.7 billion of assets and built new developments of about 8.6. So it's never going to match perfectly, but if we keep up a run rate of around about 1 to 1.5 billion of sales per year, we will then use the proceeds of that to fund our pipeline. So that's something that we've been doing for the last 5 years, and we must just continue doing that for the next 3 to 5 years, and then we would have utilized most of our land bank. So then we'll have actually quite a small pipeline after that.
Well, Fortress, when it was grappling with the issue around its dual share structure, it still managed, because it was retaining some of that earnings, to be one of the top performing property companies last year from a share price perspective. The group, coming to the sexy part of the interview as it were, logistics property is hot property, both locally and globally. But as I said earlier, you're also playing in that convenience retail space. For Fortress, which is better performing, will there be more growth for the group going forward, just in those two sectors as your priority sectors, or would you consider other sectors?
No, that's our focus, and I think we've been banging the drum for a long time that we need focus and specialization, so we've picked logistics and convenience retail. Over the last year, it really was the logistics was the standout performer. We got like-for-like NOI growth of 9.2%, and that's off quite a big portfolio of about 15 billion in South Africa. So that performance has been really good. Our retail like-for-like growth was 2.4%, and that was brought down a little bit below where we wanted it to, based on really higher costs, higher insurance costs, higher security costs. But I think going forward, we think that retail will start to get back to probably mid-single digits like-for-like growth. And the logistics will probably come off a little bit because we reduced the vacancy. But, I think both of those core portfolios are performing pretty well. Where we see a lot of the growth overall in our Fortress portfolio is rolling out our development pipeline, and that's only logistics assets. So we still have about 4.5 billion rand, both here and Central and Eastern Europe, of logistics developments to do on the land that we've already acquired. So I think the logistics portfolio will get bigger, and it'll probably be about 2/3 to 70% of our overall portfolio, with the rest being retail.
Thanks for that. Talking about the pipeline, perhaps you want to share a little bit of insight on the major projects underway in recent years. I see it's particularly focused on the two biggest economic hub provinces, as it were, Gauteng and KZN.
Yeah, we've had tremendous success with our Eastport Logistics Park, which is just past our Tambo Airport in Gauteng on the R21, which really has become quite a key route for logistics between Johannesburg, Pretoria, Mpumalanga, as well as products coming up from the east from Durban. So I think Eastport has been an unbelievable development. We're looking at deals now, securing deals of about 55,000 squares in addition to what we've done, and that will leave only two small sites on Eastport, which is quite incredible. From about 2018, we had 1 million square meters of land there, and we've used almost all of it to do logistics development. So that corridor has really gone tremendously well, and we've actually planning on expanding Eastport. We've got an option to acquire the land further north, which will add another 360,000 square meters to that park. The other one, which took a while to get off the ground, in Clarewood, which was the old Clarewood racecourse down just Durban south. It took us a while to get the planning approval, but over the last few years, it's also been tremendously successful, and we currently only have one small site there where we can build about 33 to 35,000 square meters of lettable area. So that one's also largely been done, and then we've got one more in Natal, up north in Cornubia. We own 50% of that one, and that also has two more sites to be developed. Unfortunately, we don't have that much in the Western Cape. We only have one small site next to the Supplemed DC. Wish we had got more a while ago, but unfortunately, the prices in Cape Town are quite high. But the odd thing, and even though the Western Cape is having a nice growth moment with everybody moving down there, I think still the key nodes for logistics is really around the Durban port and around Gauteng for distribution centers for the whole country and also up into Africa. So I think from a logistics perspective, we're still well placed in KZN and Gauteng.
Those two big developments you talked about, Eastport and Clarewood Logistics, what are each's development value ballpark once it's fully complete?
Eastport will be about 5 billion, and I think Clarewood about 3.5 to 4 billion. It depends what we build, but roughly there.
I'm going to catch you off guard here with Clarewood. With what's happening with Transnet and there is some positive movements with changes and talk about a foreign investor coming in to handle one of the terminals at the Durban port. Is there any plans of having direct rail links? Because some insiders have asked the question about that, because that's a very strategic site for Fortress in KZN.
Absolutely. There is a Transnet-owned rail siding on one side of Clearwood. So, we did try for many years to engage with Transnet to get a rail siding there. Unfortunately, we didn't have any success there, but there's definitely opportunity to bring rail into Clearwood, which would then, be really, I think, efficient for users who need a connection to the port and be able to put containers onto a rail siding at Clearwood and take that directly to the port. So I think we still view that as some upside for Clearwood, and are hopeful that Transnet may re-engage with us and look at doing a rail siding there.
Thanks for that, Stephen. Talking about eSport, overall you say around 5 billion. That will make it arguably the biggest industrial logistics park development in South Africa, probably in Africa, who knows. I just thought it was quite interesting. Pick n Pay is quite topical at the moment, but the company talked about Fortress fully owning that Pick n Pay massive distribution warehouse at eSport. Originally, it was meant to be some sort of joint venture, I understand. Does this impact the group in any way, especially considering Pick n Pay's woes currently? And I'm not going to go too much into the retail side, but, it is quite topical among several REITs at the moment.
Yeah. So we have exposure to the Pick n Pay group really in two sides of our business, obviously the logistics in this DC, and then on the retail, we have mostly exposure to Boxer on the retail side, 9 boxes, 6 Pick n Pays, but 2 of the Pick n Pays will convert to Boxer. So we'll have 11 boxes on the retail side. And that business is tremendously strong in our retail centers. I mean, they really are one of our standout performers and are growing quite quickly in our portfolio. On the logistics side, we only have exposure to the Pick n Pay group through the eSport distribution center, which is a key operational asset. It's brand new, and the rentals are at market, if not below market. So, I really don't think we'd have a problem reletting that space if we had to. But at the moment, we actually quite comfortable. Pick n Pay are paying us the rent. They are performing well. They have a solid plan. So we aren't losing that much sleep over Pick n Pay exposure, both on the distribution center and the retail, because where you've got assets that perform and are well located, you can always relet them, regardless of what happens specifically to a certain tenant. So I think that gives us a lot of comfort that we've got well located real estate that we can release. But I'm really, really confident that Pick n Pay will sort out their structure, and I think that Boxer business is exciting, and I think once people can see the value of that, it should start to really underpin a lot of the value within the Pick n Pay group.
I'm cognizant that I'm already over 20 minutes with you, but just a quick further 2 questions is on Fortress's offshore investments. Obviously, it's linked to NEPI as a shareholder in NEPI. How important is your offshore side of the business for the group?
We like it. We think it's a great diversifier, and I think it's done very, very well for us. But there are no sacred cows. NEPI's a great performer. We own 16.2% of that. I think there's some great tailwinds in Central and Eastern Europe, and hopefully we'll capture a lot of that through our shareholding in NEPI as well as our direct logistics. But if there's, as you've seen in January this year, when shareholders voted to utilize 1/3 of our NEPIs to repurchase the B shares, we're quite happy if there's a corporate action that makes sense, that we can use any of the assets on our balance sheet to unlock value or to create more value.
Just to conclude, personally, you've been part of the change. A lot has changed in Fortress over the last few years, not just the share structure issue. Since your time, since becoming CEO, how long have you been in the hot seat, as it were, and what's your core focus going forward?
Yeah, I've been at Fortress for just over 10 years. I've been CEO for 5 of those 10 years. I think we've really tried to simplify the business and to focus on specialization. Where you look globally at a lot of real estate companies, be they REITs or just listed property companies, the ones that continually outperform are the ones with focus and specialization. So we haven't been keen on being a big diversified fund. In fact, we think that specialization and focus must never be sacrificed for size. And I think when you look globally at the US and the UK, the funds that have focused on size over specialization and focus have generally performed quite poorly. So we're very, very keen on focusing on logistics and retail. Those are the markets we know and understand, and we want to become really expert in those two markets. So I think that's what we need to do going forward, and just over time make the incremental steps towards our strategic goal of getting rid of the non-core and rolling out the pipeline.
Stephen, we will have to leave it there. Thanks so much for your time. That was Stephen Brown, the CEO of JSE-listed Fortress.
Thanks for listening to the Moneyweb Property Pod with Suren Naidu. To listen to more episodes, go to moneyweb.co.za or the Moneyweb app and follow Moneyweb News for daily updates. Follow Suren on Twitter @Suren Naidu for more of his property industry content and other business stories. The Property Pod.